It has taken me a lifetime to see it, but I am now certain of something most financial advisors will never admit. Their standard retirement advice, the kind that says you need millions to retire comfortably and should only withdraw a tiny percentage each year, it's often designed for people who don't truly understand how money works. I realize this especially when considering those over 60 who might have saved a more modest sum. I've been investing for over 70 years now, ever since buying my first stock back in 1942 at the tender age of 11. And in all that time, I've studied how money works, how businesses generate profits, and how ordinary people can claim a piece of that profit for themselves. What I've learned is that the difference between those who struggle financially in retirement and those who thrive isn't necessarily how much they saved, but how they use that money. It's the strategy they employ to generate income. Now, I know what some of you are thinking. A substantial income from a more modest nest egg sounds too good to be true. And I understand that skepticism. You should be skeptical of anyone promising unrealistic returns. But I am not talking about speculative gains. I am not talking about hoping your stocks go up. I'm talking about a systematic approach to generating income from your investments, combining dividend stocks, strategic positioning, and a technique most retail investors have never even heard of. It's a technique the wealthy have been using for decades to generate consistent income, regardless of what the market does. Let me take you back to 1974 for a moment. The stock market had just crashed. We were in the middle of stagflation. Inflation was running at double digits. Unemployment was rising. The Dow Jones had fallen by almost 50% from its highs. Every newspaper, every magazine, every television expert was telling people to get out of stocks, to hide in cash, to wait for better times. And do you know what I was doing? I was buying. I was accumulating shares of quality companies at prices that seemed insane at the time, but turned out to be the opportunity of a lifetime. But more importantly, I was focused on something that most investors completely ignored: income, not price appreciation, but income, because I understood something fundamental about investing that most people miss. You cannot control what the stock market does tomorrow or next year, but you can control how much income your portfolio generates. And if your income exceeds your expenses, you never have to worry about market crashes again. You never have to sell at the bottom. You just keep collecting your checks and wait for the storm to pass. That insight has guided my investment philosophy for over 7 decades. And today I'm going to show you exactly how to apply it to your own situation. This is not theory. This is practical, actionable strategy. Let me start by explaining the foundation of this approach. It begins with understanding the difference between total return and income return. Most financial advisors focus exclusively on total return. They tell you to build a diversified portfolio, wait for it to grow, and then sell pieces of it to fund your retirement. The problem with this approach is that it makes you completely dependent on market conditions. If the market crashes right when you need to sell, you lock in losses. If you sell during a downturn, you deplete your principal faster than expected. And worst of all, you spend your entire retirement worrying about whether your money will last. The income approach is fundamentally different. Instead of building a portfolio designed to appreciate and then selling pieces of it, you build a portfolio designed to generate income. You focus on investments that pay you regularly, regardless of what the stock price does, and you structure that income to exceed your expenses. So you never have to sell anything. Your principal stays intact, generating income year after year after year. Now, let me be very clear about something. Generating a substantial income from a more modest nest egg requires a more sophisticated approach than simply buying dividend stocks. The average dividend yield on the S&P 500 is only about 1.5%. Even high-yield dividend stocks typically yield only a few percentage points. To generate the returns we are talking about, you need to combine multiple income strategies, and that is exactly what I am going to teach you. The first component of this strategy is building a foundation of high-yield dividend stocks, not just any dividend stocks, but stocks that have been specifically selected for their high current yield and their ability to maintain those dividends through economic cycles. These are typically found in specific sectors that have structural reasons to pay high dividends. Let me tell you about the first sector, real estate investment trusts, or REITs. These are companies that own and operate income-producing real estate. By law, REITs must distribute a large portion of their taxable income to shareholders. This legal requirement is why REITs consistently offer higher yields than typical stocks. Many REITs yield several percentage points, with some yielding even higher, but you cannot just buy any REIT. You need to focus on REITs with strong fundamentals, stable tenants, and long track records of maintaining their dividends. I look for REITs that own essential properties, medical office buildings where doctors and hospitals lease space, single-tenant retail properties leased to recession-resistant businesses like drugstores and dollar stores, industrial properties, and warehouses that benefit from the growth of e-commerce. These are the types of properties that generate stable rent payments. I've always been fascinated by the idea of generating income almost passively from the market. Imagine creating a reliable income stream from real estate without dealing with tenants or repairs. That's where real estate investment trusts, or REITs, come in. By allocating a portion of your portfolio to high-quality REITs, you can generate a stable income, regardless of economic conditions. Let's say you allocate $50,000 of a $150,000 portfolio to a diversified basket of REITs, yielding an average of 7%. That's $3,500 per year, a foundation of reliable income from real estate. The next sector I often consider for high yield is business development companies, or BDCs. Think of them as publicly traded private equity firms lending money to middle market companies. They're required to distribute at least 90% of their income to shareholders because they lend money at higher interest rates to companies that can't access traditional bank financing. The yields can be substantial, often between 9 and 12%. Now, I do need to offer a word of caution about BDCs. They are riskier than REITs. The companies they lend to can default, especially during recessions. So selectivity is key. I look for BDCs with experienced management teams, diversified loan portfolios, conservative leverage ratios, and long track records of maintaining their dividends through economic cycles. There are a limited number of BDCs that meet these criteria, and those are the ones I'd consider. If you allocated $30,000 to a diversified basket of these high-quality BDCs yielding around 10%, you'd generate another $3,000 per year. That brings the total so far to $6,500. But we're not done yet. There's also energy infrastructure, master limited partnerships, and corporations that own pipelines, storage terminals, and processing facilities. These companies essentially collect fees for transporting and storing oil and natural gas. Their revenue is based on volume, not commodity prices, so their cash flows are remarkably stable regardless of oil prices. These companies often yield between 6 and 9%, and the best ones have been consistently increasing their distributions for decades. I look for companies with long-term contracts, investment-grade credit ratings, and diversified asset bases. The workhorses of the energy sector, generating consistent income year after year. If you allocated $20,000 to a diversified basket of these, yielding an average of 8%, that's another $1,600 per year, bringing the total to $8,100 annually. That's a solid foundation, but we need more to reach our goal. And this is where things get really interesting. Selling covered calls. It's a technique that many retail investors haven't explored, but it's one of the most reliable ways to generate income from stocks you already own. When you own shares of a stock, you have the right to sell those shares at any time at the market price. A covered call involves selling someone else the right to buy your shares at a specific price by a specific date. In exchange for selling them this right, they pay you a premium in cash immediately, regardless of whether they ever exercise that right. For example, imagine you own 100 shares of a stock trading at $50 per share, a $5,000 investment. You could sell a covered call with a strike price of $55 expiring in 30 days. The buyer pays you, say, $1 per share or $100 total. That $100 is yours to keep no matter what happens. If the stock stays below $55, the option expires worthless. You keep your shares and the premium. You can then sell another covered call for the next month and collect another premium. If the stock rises above $55, the buyer exercises their option and you sell your shares at $55. You made $5 per share in capital gains plus the $1 premium. Either way, you win. By selling covered calls consistently on stocks you own, you can generate an additional 8 to 15% per year in premium income on top of any dividends those stocks pay. Now let's apply this to your portfolio. Suppose you allocate $50,000 to a basket of stable blue chip stocks, companies in the consumer staples sector, utilities, or large cap value stocks. These stocks might yield 2 to 3% in dividends, or about $1,250 per year. But if you sell covered calls on these positions consistently, you can generate an additional 10% in premium income. That's $5,000 per year. Combined with the dividends, your $50,000 allocation is now generating $6,250 annually. That's a 12.5% yield. Let's add this to our running total. REITs, $3,500, BDCs, $3,000, energy infrastructure, $1,600, blue chip stocks with covered calls, $6,250. That brings our total income so far to $14,350. We are getting closer, but we still need to generate another $10,650 to reach our goal of $25,000. This is where we get more aggressive with the covered call strategy. Instead of just supplementing dividend income with covered calls, we can use covered calls as the primary income source on a portion of the portfolio. There are exchange-traded funds specifically designed for this purpose. They own portfolios of stocks and systematically sell covered calls on those positions, distributing the premium income to shareholders monthly. These covered call ETFs typically yield between 10 and 14%. Because they are diversified across many stocks, the risk of any single position hurting you is reduced. They do this professionally with teams dedicated to optimizing the strike prices and expiration dates to maximize income while managing risk. If you allocate the remaining portion of your portfolio, let's say $50,000, to a COM, I've been running some calculations, and it's fascinating how different income streams can add up. Combining covered call ETFs, for instance, can yield an average of 12%. That could generate, say, $6,000 per year in additional income. Let me walk you through a possible scenario. We might have $3,500 from BDCs, $3,000 from energy infrastructure, $1,600 from blue chip stocks with covered calls, bringing in $6,150, and those covered call ETFs adding another $6,000. That brings us to a total annual income of $2,350. It's a good start, but perhaps not quite enough. To bridge that gap, I often suggest cash-secured puts. Think of it as the mirror image of a covered call. Instead of selling someone the right to buy shares you own, you're selling them the right to sell you shares at a specific price. In return, they pay you a premium. Here's how it might work. Imagine you have $10,000 in cash that you're willing to invest in a stock if it drops to a price you like. You sell a put option with a strike price below the current market price. The buyer then pays you a premium. If the stock stays above that strike price, you simply keep the premium. If it falls below, you buy the shares at the strike price, but you've effectively paid a lower price because of the premium you collected. By cycling cash through these cash-secured puts, you can often generate an additional 5 to 10% per year on your cash reserves. If you were to keep $20,000 available for this strategy and generate, say, 8% in premium income, that would add another $1,600 per year. So let's look at a final tally. REITs at a 7% yield on $50,000 equals $3,500. BDCs at a 10% yield on $30,000, that's $3,000. Energy infrastructure at an 8% yield on $20,000, that's $2,600. Blue chip stocks with covered calls at 12.5% on $50,000, that's $6,250. The $20,000 allocated to covered call ETFs at 12% generates $6,000. And those cash secured puts generating 8% on our remaining cash of approximately $20,000 adds another $2,600. Adding it all up, $3,500 plus $3,000 plus $1,600 plus $6,250 plus $6,000 plus $1,600, that equals $21,850. We're getting very close to a comfortable income. And here's the thing. I've been rather conservative in these estimates. Many high-quality REITs yield closer to 8%. Some BDCs yield 11 or 12%. And covered call strategies can generate 15% or even more in favorable market conditions. By optimizing each component, reaching $25,000 is absolutely achievable. But let me be very clear about the trade-offs and risks involved in this strategy, because nothing in investing comes without them. And I would be doing you a disservice if I didn't explain them clearly. First, high-yield investments invariably carry higher risk than lower-yield investments. There's a reason REITs and BDCs yield more than Treasury bonds. They are quite simply riskier. Companies can cut their dividends. Defaults can occur in loan portfolios. Energy infrastructure companies can face regulatory challenges. You are being paid to take on this risk. The key is managing that risk through diversification and careful selection of quality investments within each category. Second, covered call strategies limit your upside potential. When you sell a covered call, you are agreeing to sell your shares at a specific price. If the stock rockets higher, you miss out on those gains. You still make money, but not as much as you would have if you had simply held the shares. This is the trade-off for generating consistent income. You sacrifice some upside potential in exchange for reliable premium income. Third, this strategy requires more active management than a simple buy and hold approach. Covered calls expire, so you need to roll them to new positions. You need to monitor your holdings and make adjustments. This is not a set it and forget it strategy. If you are not willing to spend a few hours per month managing your portfolio, this approach may not be right for you. Fourth, option strategies have tax implications. Premium income from selling options is typically taxed as short-term capital gains, which is taxed at ordinary income rates. This means a portion of your income will go to taxes. In a tax-advantaged account like an IRA, this is not an issue. But in a taxable account, you need to factor this into your planning. Now, let me tell you why I believe these trade-offs are often worth it for someone over 60 with, say, $150,000 to invest. The alternative might be following conventional advice and withdrawing 4% per year, which gives you $6,000 annually, or putting everything in bonds, yielding 3% and getting $4,500, or perhaps waiting another decade to retire while inflation erodes your purchasing power. The reality is that for someone over 60, time is often your most precious resource. You cannot wait another 20 years for your portfolio to grow. You need income now. This strategy provides that income while keeping your principal largely intact. Let me tell you a story that illustrates why this matters so much. Back in the 1990s, I knew a man named Frank. He was 62 years old with about $180,000 saved for retirement. Every financial advisor he spoke to told him he did not have enough. They said he needed to work another 10 years, save more money, and build a larger nest egg. Frank was devastated. He had worked his whole life and was facing another decade of labor just to reach some arbitrary number. Frank came to me and asked what I would do in his situation. I told him about income investing, about focusing on cash flow rather than total return, about building a portfolio designed to pay him rather than a portfolio designed to grow. We worked out a strategy similar to what I have described today. High-yield investments combined with covered call strategies to maximize income. Frank retired at 63. His portfolio generated enough income to cover his expenses. He did not have to touch his principal. And the beautiful part, because he was generating income rather than selling shares, market crashes did not hurt him. When 2008 happened and the market fell 50%, Frank just kept collecting his dividends and option premiums. He did not panic. He did not sell at the bottom. He just waited it out while his income kept flowing. Frank lived until he was 89 years old, 26 years of retirement. And when he passed, his portfolio was actually larger than when he started. The power of income investing isn't about stressing over market crashes or worrying if your money will last. It's about reliable income, enough to actually enjoy life. I want that for you. So how do we put this into practice? First, you'll need a brokerage account that allows options trading. Most major brokerages offer this, but you'll need to apply for options trading permission. For covered calls and cash-secured puts, level 1 or 2 options approval is usually enough, and it's relatively easy to get. Next, divide your portfolio according to the allocation I talked about earlier. Roughly $50,000 to REITs, $30,000 to BDCs, $20,000 to energy infrastructure, $50,000 to blue chip dividend stocks for covered call writing, and $20,000 in cash for cash secured puts. Of course, adjust these numbers to fit your specific situation and how much risk you're comfortable with. Then, research and select specific investments within each category. For REITs, look at companies like Realty Income, which has paid monthly dividends for over 50 years, National Retail Properties and Medical Properties Trust. Diversify across different property types and geographies. For BDCs, research companies like Main Street Capital, which has an exceptional track record, Ares Capital and Hercules Capital. Look for experienced management teams and conservative leverage. For energy infrastructure, consider Enterprise Products Partners, Energy Transfer, and Kinder Morgan. Focus on companies with investment-grade ratings and diversified asset bases. For your covered call portfolio, Select stable blue chip companies with liquid options markets, consumer staples companies, large utilities, major banks, companies whose stock prices are relatively stable because that makes covered call strategies more predictable. The next step is to learn how to sell covered calls. It's simpler than most people think. Your brokerage platform will have an option chain that shows all available options for any stock you own. You select an expiration date, typically 30 to 45 days out. You select a strike price, typically 5 to 10% above the current stock price, and you sell to open the call option. The premium is immediately credited to your account. Over time, manage your positions. When options approach expiration, you either let them expire worthless and sell new ones, or you roll them forward to a new expiration date. This is a routine process that takes maybe an hour or two per month once you get the hang of it. I know some of you are wondering about market crashes. Actually, this is when income strategies really shine. During the 2008 crash, dividend-paying stocks dropped in price just like everything else, but most quality companies maintained their dividends. Investors who focused on income kept collecting their checks and waited for the recovery. They didn't have to sell at the bottom to fund their expenses. Their income gave them the ability to be patient. And what about inflation? A legitimate concern with any fixed income strategy. The good news is that dividend growth stocks tend to increase their dividends over time, which provides some inflation protection. Also, covered call premiums tend to increase during periods of higher volatility, which often coincides with inflationary periods. The strategy isn't immune to inflation, but it provides better protection than bonds or cash. Can you start with less than $150,000? Absolutely. The principles work at any scale. The specific allocations might be different, and you'd need to adjust your income expectations accordingly. But the core strategy of combining high-yield investments with covered call income generation works, whether you have $50,000 or $500,000. And if you need more than $25,000 per year, scale up the strategy. The percentage returns are what matter. If you need $50,000 per year, you need approximately $300,000 deployed in this strategy. The math scales linearly. Let me leave you with some final thoughts. The traditional retirement advice, the advice that says you need millions of dollars and decades of saving before you can retire, that advice serves the financial services industry, not you. It keeps you working longer, paying more fees, and feeling anxious about your future. The income approach I've described today puts you in control. It generates cash flow that supports your lifestyle. It reduces your dependence on market appreciation, and it can work with amounts of money that traditional advisors would say are insufficient.